Hi, my name is Richard Pennell from the Mortgage Home. It's been a whole week since I last gave a mortgage update, so I thought it was about time I came on and just give you my view as to where things are a week later. Um, so just before we get into what's happening right now, I just want to recap. So 23rd of September was when the Conservative government did their mini budget. That absolutely put oil petrol on the flames when it came to the markets, finance, mortgages, you name it. Obviously, everyone reacted badly to that. Um, the pound slumped to the dollar. Ultimately, there was a continued upward pressure on inflation as a result of this massive giveaway and indeed the sterling slump to dollar. So the first thing that high street banks did was to pull their mortgages because they were expecting the Bank of England perhaps to come out with some sort of emergency meeting to increase interest rates a lot quicker. That actually didn't happen. So we don't yet have any clarity from the Bank of England, which means that the high street banks are really unsure how to price their next lot of mortgages. So this is really where we are right now. Now, yes, we've got a real lack of products out there, lack of lending, but is it anything like 2007 and 8 crash? Absolutely not. Not in the slightest is it associated with that time. Today, the reason we don't have that is exactly what I've said. It's a pricing issue that the high street banks are really unsure just how to newly price these mortgages based on what they think the Bank of England rate's going to be doing. Because their mortgage products are directly linked to that Bank of England rate. So they really want to know is how quickly and by how much will the Bank of England increase rates? And until the Bank of England shows its hand, it's really, really difficult for these high street banks and the guys there that price these products to come out with some certainty about just how to price them. So we've got this hiatus. We've got a bit of a vacuum at the moment with the high street guys. So attached to that, we've got a second group of lenders, the non-high street bank lenders. So these are people like Kensington, like Precise, like Aldermore, the mortgage lender, Pepper, plus plenty of other lenders that are not banks. So even though they're where they price their mortgages has got very little to do with the Bank of England rate, these are smaller, more nimble lenders, whereas your high street banks are the oil tankers of the mortgage lending world. So these little lenders who usually price higher than the high street banks are now finding themselves, if they were to price at the cheapest lender out there. And they couldn't cope with that. They couldn't cope with being the cheapest lender because the high streets are not lending. They would be swamped. The customer service would go through the floor. They'd probably run out of funds to lend. So these guys have also had to withdraw their mortgages, and then they're looking to the high street guys to reprice so that these secondary lenders can come back in and price that little bit higher. So again, we've got this Mexican standoff right now between the Bank of England and the high street banks, and then the high street banks to the non-bank lenders. So where are we right now on the 4th of October? Well, the high street banks are really, really slowly starting to come back in. How long will that take before all the high street banks have repriced and put their mortgages back on offer? Genuinely, I can't say right now. Is it going to take a few weeks? It could take a full month because, as I said, they're waiting for the Bank of England to show its hand. And right now, the Bank of England's saying, we ain't going to do that until the 3rd of November. That's a month away. So hence we're seeing this very slow revealing of what the new prices are likely to be with the high street guys because they just don't have much confidence. And of course, therefore, we've got the non-bank lenders waiting in the wings. What I can say is that the days, if we're focusing on buy-to-let, those days of 3 to 5% interest rates, certainly fixed rates, have disappeared. They've gone out the window. So if we talk about buy-to-let and 75% borrowing right now, then those new rates where those lenders are still lending are at between 5.5% and 7.5%. If you're prepared to gamble, and generally I don't know anyone that is, discounted variable rates are 3.5% to 4.5%. But please be warned. Once the Bank of England do show its hand, if that is the 3rd of November, there will be a rate hike. It's just how big that is. And of course, if you've taken a discounted variable, that means your interest rate will pretty much go up immediately. On residential side, their fixed rates, well, they're about 5.5% to 6.5% right now. Again, if you can be putting in a 25% deposit. Interestingly, if you're prepared to fix for longer, those rates are being priced cheaper. And I'm seeing that also on the buy-to-let side. So I'll just repeat here. Because of the turmoil over the next, I would say, couple of years, lenders are pricing their fixed rates at higher than the 5-year fix. So I can't remember a time when 5-year fix were cheaper than 2-year fix, but we're now seeing that more and more over the last few weeks. There's been parity with 2-year and 5-year fix for a number of months, but literally in this last week now, 5-year fixed deals are now being priced cheaper than a 2-year fixed, and that's down to this uncertainty that's out there. So it's interesting that the lenders, both high street and non-high street, have got more confidence to price lower when we're looking beyond those 2 years. So interesting observation there. So of course we've got a lot smaller number of products to focus on and research right now, but the rates I've sort of mentioned in terms of the spectrum of interest rates, I wouldn't expect that to change too much in the next month. So what has changed? Well, again, if I can just focus on buy-to-let, because that has been the biggest shift. The stress rate calculation, I really want to focus on, which maybe in the past you've let your broker worry about that and understand that, and he or she'll just tell you what you need to, what you can borrow. But now I think it's time you understood it in a little bit more depth. So this calculation essentially is telling you how much you can borrow based on the rental income. Now, I've got to generalize for this next section, so please bear with me. So as a general rule of thumb, the formula that banks and lenders use is split into 2 parts. The first part is this stressed interest rate. It's an artificially higher rate than you're going to be paying for your actual mortgage, but the lenders use it to work out what they're going to lend you. And as I say, it's artificially higher than the rate you're going to be paying. In the old world, roughly speaking, that rate was 5.5%. So even though you might have got a 3.5%, 4% interest rate, the banks were saying, no, we're going to be prudent and we're going to use this 5.5% to work out what your interest only mortgage payments are going to be. And essentially, your rent has to cover the mortgage payments at that higher rate. What I'm seeing literally in the last few days is that 5.5% is being replaced by an average rate of around 8%. So now your rent has got to cover the mortgage payments using an 8% interest rate, not 5.5%. I've not finished yet. Let's come to the second part. So they said the formula was in 2 bits. So let's park that first bit, that the rent has to cover the mortgage payments at an artificially high rate, perhaps 8%. The second part of this formula, even after working out the mortgage payments using that higher rate, as I said, that the rent then has to cover that higher payment by another factor of about 1.4. So once you've worked out what that high mortgage payment is at an 8% interest rate, then you increase that figure by, in the past, about 1.4 times. And the rent has to cover that. So the rent is artificially increased in 2 sections. Now, that 1.4% is an area where you might have some control to shift that slightly. So here's some tips and tricks that you might want to consider. First of all, if you're prepared to lock in for a longer fixed rate, i.e. a 5-year fixed or longer, 7, 10 years, there's more of these products coming out now, then instead of this 8% interest rate I mentioned a minute ago, quite often the lenders will say, we'll use the actual interest rate from your 5 or your 7 or your 10-year fix. And if that is 5, 6, 7%, then ignore the 8% I've just said and replace it with a lower interest rate. So if you're prepared to lock in for longer, you'll get a more favorable borrowing calculation. Point number 2, if you're a high rate taxpayer, then you've definitely been given this factor of 1.4 times. But if you're prepared to buy in a limited company, then that 1.4 gets dropped to usually about 1.25 times, so that your rent doesn't have to be quite as high as if you're a higher rate taxpayer. If you're a basic rate taxpayer, generally speaking, the banks and non-bank lenders have used this figure of 1.25 times. So you get penalised if you're a higher rate taxpayer. So is there a way that it could be bought by a basic rate taxpayer, or indeed put it into a limited company? Then you might be able to get that calculation more in your favour. Of course, be thinking about putting more deposit in, because if these calculations are a lot harsher now, we may struggle to get up to 75% lending. So be thinking about the amount of deposit and the leverage that you're going to maybe get to going forward may well be less than 75%. The last thing I want to mention on this point 4 is something called top slicing, where if there is a shortfall, there are a number of lenders that will look at your personal earned income from what I would call your day job, if you have one, if you're not a portfolio landlord, where the entirety of your income is from land and property. If you also have an employed position, for example, or you have a trading self-employed role with surplus income, that sometimes can be used where there's a shortfall in the rent. So there are some lenders that will consider that. So speak to your broker about top slicing. So just to summarize, if on buy to let you're looking at 75% borrowing, if you are buying or refinancing your cheaper properties, perhaps up to £80,000 in value, then you should still be okay to get your 75% lending, whether that's refinance or purchase. But as we go above 80, 90, 100, and obviously up to 150 and above, then generally speaking, yields do start to drop. And that's where you're likely to find it more difficult to get that 75% lending, because the stress rate calculation is now penalising you more. And it's because the yields tend to be lower, that's where you may find that you will struggle to get to the 75% borrowing. And you may have to look at those 4 tips that I've just mentioned to see if you can still get that level of borrowing. If you're getting a HMO or you've got a HMO, these are more cash flow rich. That should still be okay. If you're looking at serviced accommodation and holiday lets, these are going to be less affected and that's where we're using lenders that work off the SA and holiday let calculations, not your AST rental equivalent, because service accommodation, holiday lets tend to be higher in cash flow rich type of strategy. Do also remember that green mortgages have been out there now for some time. So if you manage to get your EPC rating to A, B, perhaps a C rating, it might be that you're eligible for improved rates. Lenders have now differentiated their products. They've been out there for some time. If you can get your EPC rating A to C, then there are still cheaper products out there. Final comment about where we are right now, service levels. Service levels are really erratic with lenders for all the reasons I've said earlier. There are some lenders that are still managing to process mortgages in a decent amount of time, but then you see other lenders where the service levels have absolutely dropped through the floor. What I would call normal service levels, if they can assess an application in 2 to 3 days, that's as good as it gets. But there are a number of lenders, sadly growing, where those service levels are anything up to 28 days just to assess an application. So bear that in mind when and getting your expectations accordingly. Be mortgage ready. That's another thing I would say to you guys if you are still looking to purchase or you're looking to refinance really soon. Get your documentation all lined up. If you're self-employed or you've got buy-to-let rental income because you've already got properties, make sure that you've got your April 22 tax returns already done. Forget the January deadline that the HMRC say you're allowed to do. Pretty much most lenders now will expect you to have your April 22 returns done. So if you haven't got them done already, contact your accountant or you're doing yourself, get those returns in. If you haven't done a mortgage for a while and you don't know what your credit report looks like, get one, an Equifax or an Experian credit report. Get those done. Check your bank statements. Have they got your old home address still? Because you're on online banking, you don't check what that address is or you haven't updated it. Get it updated. ID, have your passports expired? Get those done. Driver's licenses, same again. Has that got an old address on? Quick comment about the property market. There's still a lot of media headlines out there about the property market coming into a crash and dropping significantly. I'm not seeing that at all. Absolutely. Is there a slowdown? Yes, of course there is. Is it flatlining? Perhaps it is right now, even maybe some really modest drops in property prices, but not a crash. There are still plenty of 80 and 85% lending on offer by the lenders. There isn't the raft of products out there, but they're still lending at 80% at the level they've been lending at all year. So that tells me that those lenders don't expect a property crash anytime soon. It is, of course, an evolving situation. We are in this new chapter, and I can't still yet see that full picture of what this new world looks like. As I said, we're hoping that over the next 3 or 4 weeks, we'll get the full suite of products back out there. But I will be putting out another mortgage update as soon as I have more information on this new world. So the message is, look, don't panic, be patient, get individual advice. It is about the individual. I have tried to generalize across this, so please do bear that in mind. Get that impartial, independent advice so that you can get the full information and enough information so you can be making your decisions going forward. Other than that, take care, and we'll bring another update out as soon as there's more information to share. Thank you.